Welcome to the Daily Update. This is being prepared Thursday, March 10th, where we'll go over the action in the market today and then see how things look for Friday, March 11th. And it was not a real crazy day as far as price action. It was a crazier day as it applies to economic news and geopolitical news, but really the market kind of behaved. It didn't really shoot off in one direction or the other. Unfortunately, we're still kind of in undecided land as far as which way the market wants to go. We were down, but we spent most of the day clawing our way back. And even though on a closing basis, we finished lower, we didn't finish lower in a new place. We're kind of where we've been already. So it's kind of interesting, but what I'll be focusing on most today is the inflation information that came out. There are things developing in the geopolitical front and then oil and so forth, but we had the big CPI come out and that was about as expected. It depends on who you read. One source that I go to says it was as expected. Somebody else came out and said it was higher than expected. So what they do is they take all these economists and they reach a consensus, and then that's what the market is hoping for. And so different places might take a little different average or consult different economists. And if we come in at expectation, which is what we kind of did on Friday, then the market kind of blows that off. And we could then say, well, the market didn't really move around all that much because of the reports, since it came out as we already thought it was going to. Where we get a big move up or down is when the report comes out and it's a lot different than that overall consensus. And so then it decided to focus on other things, but still we need to focus on what the CPI and the inflation report that came out, what that said, because it has a heavy influence on not only the stock market, but also for us personally, economically. So let's go back and look at what happened. The futures, they gyrated all over. When the report first came out and it was about as expected, we saw the S&P futures actually scream a bit higher. But then as we got closer to the open, that started to fade and go a little bit lower, and that developed into a gap lower at the open. And then selling, there was some buying in there, but most of all we saw selling, and that took us down to about 42.10 before we found a base to work from. That wasn't a pivot level. It wasn't, it might have been a moving average or a pivot level in some other index, but we kind of stopped at this more round number. It is a strike price, so that might have had some influence. And then we were able to kind of claw our way back or chop our way higher. This is toner, the pivot level. Okay, it should be to another pivot level. The basic daily pivot, my goodness, the daily basic pivot level, where if we're above that pivot level, it's seen as more positive, and if we're below, it's negative. Well, prices chopped back up to that level, which then became resistance. And even though we were down overall, we did close near the high for the day, but we ended up being down 0.43%. One thing that is kind of interesting is that volume was below average. You had a big report come out. You saw volume actually taper off. And so usually on those days are when we see a lot of volume activity. What we're looking at now are the technicals, and they're pretty much negative across the board. That really hasn't changed. I'll try to point out some positive things as we go through it. We're getting, again, near the end of earnings season. Amazon was kind of the real big story that came out on Thursday, and not so much earnings, but the fact that they're doing a, was it a 20-for-1 stock split? And that's always seen as a positive thing. And that really pumped up the price of Amazon and helped the overall tech sector the most. But then inflation and interest rates, those are the things that we'll kind of focus on here. And then the geopolitical concerns, what's going on between Russia, Ukraine, the different talks that are going on concerning oil, the debates that are going back and forth, and the feel good things that are happening right now. Are they going to bleed over into longer term feel bad scenarios as we go forward? Some comments, we're still in correction territory. We did decline a little bit. The technicals are negative. We're still showing extreme fear. Prices still, believe it or not, folks, they remain in a range. And then, of course, we have Russia, Ukraine, the oil issues, and inflation. The CPI did come out, and it was as expected, but it's still very high. We're seeing inflation very, very high right now. And I'll go into that here in just a little more detail in a minute. The market continues to be overvalued. And then the trend now, we're pretty much negative across the board. The ADX is suggesting that we're in a trend, and that trend is negative. The bias, since we had a down day, is negative, and we've been negative, even though we had the up day on Wednesday, we're still negative overall as far as momentum. Although one of our momentum oscillators is showing a little bit of improvement, and I'll point that out. So let's go back, look at the day's session, see what happened, see how people are feeling. So we want to look at sentiment. We're still below 20. We actually dropped a little bit. We were given 16, and this seems to change. I thought this was saying 17 when I did yesterday's video, and then it dropped down to 13. So I'm not quite sure what to make of that, but still, overall, we are below 20 at 15, and then we're still below this level. Now, this is showing extreme fear. And a lot of times, good things for the stock market can happen when we get to that point. But there's still so much indecisiveness out there. There's so much propaganda. There's so much information going back and forth that one week it's considered a conspiracy theory. The next week, they're coming out and saying this is what's really happening. And then there's some flip-flops going back and forth. And just to find truthful information is a real challenge right now. Then we did have the asset managers, those that actively manage mutual funds. And I brought this up last time, where there's this debate between an index mutual fund and an actively managed mutual fund, where the manager goes out, tries to find the next great stocks or areas to invest in. When we're in a good, solid bull market, the studies that I've read show that index funds tend to do really well. When we're going sideways to down, actively managed mutual funds tend to do better. And this just rates their overall risk, either risk on or risk aversion methods. And we're seeing a real drop in that. But even asset managers, they're human beings too. And they can go extreme positive or extreme negative at the same time. So but they're supposed to be smart people who manage these mutual funds. And I'm not saying any of them are not smart. They have their own methods, and sometimes their methods work out really well, and sometimes they don't work out well. But when they're, especially with a mutual fund, they have to do what their prospectus says. So they can't go outside of that. So even if they have a philosophy that you like, they might have to get into dangerous areas because their laws or the prospectus for that mutual fund says that's what they have to do. But we've been seeing a real kind of a decline overall. It's pretty choppy, but going from more risky assets to less risky assets. Well, since we saw this chart last time, they've actually bumped up their riskier assets just a little bit. So that's what we get. And it comes out on Wednesday, but they don't really update it till Thursday. So I can't really show it to you until I'm preparing Friday's video. And then I'll also include this in the weekly video that I do over the weekend. We also had the American Association of Individual Investors, which I belong to that and have been a long time member, but most of my fellow members tend to be wrong. They tend to react instead of proact. And if the market's going down, they are negative and sell at just the wrong time. If the market's really going up, they tend to overreact and buy at just the right time. And as a whole, we can then use this as a contrary indicator. We had bumped back up from last week's reading, but now we're down here. We're below 20. We're at negative 21 right now. We could go lower, but this is showing that individual investors are seeing what's getting to be extreme fear, and they tend to do the wrong things at the wrong time. So that could also be a potential positive. Then another thing that comes out is the Ridex ratio, is what I call it. They take those folks that get into the bearish funds that make money if the market goes down, and then they divide that by the bullish funds where you make money if the market goes up. And we're starting to see a bit of a spike up in overall bearishness. It's not an extreme reading, but it's getting back to some high points that we've been at before. So this could also be suggesting, and I wanted to give you some historical perspective here, but we don't want to just use historical perspective to tell us what's happening now, because this looks small, but we want to look at it in the proper context, but also realize that things are viewed differently now than they were 10, 15, 20 years ago. So this is starting to also show extreme pessimism right now. Now, looking at our daily gauge of fear, we actually saw with a down day, interesting, we saw the VIX decline on a closing basis. On the bar chart, we're still seeing kind of an overall series of higher highs and higher lows, but we did decline and we closed near the bottom for the VIX on Thursday. Okay, we had a down day. There's a lot of things going on right now. And to see our fear gauge actually drop, that's not usually what we see. Then the Vixen, or I want to call this the Vixen, it's the VIX of the VIX. It also declined from Wednesday to Thursday, and on a closing basis also showed a tapering off as well. The Ulcer Index, it actually dropped a little bit overall. This is another fear gauge that we can use. Well, it just shows that we're not really seeing a spike in fear right now. And then to also get a longer term historical perspective. As far as our sectors, since we had a down day, I sort according to what finished down the most. Tech got hit with staples. That's kind of interesting. That's a value play. It got hit. And then if you look at the bottom, the sectors that were up, discretionary actually bounced a bit. And then energy, which saw a pretty solid day on Thursday. Then this is overall, energy's in the lead with discretionaries in showing the weakest return so far since the all-time high. As far as inflation, and this is where I'm going to spend a little extra time going through things. The Baltic Dry Index, it is starting to advance. And so and we're seeing inflation, we're feeling inflation, we know inflation is happening, and so we want to see that reflected in this. Well, it has been going up a little bit stronger lately. What would really be nice is we need indicators that tell us what's happening before it actually happens, before we actually feel it. And this isn't really helping us that much. What I'm looking at, even though it declined a bit, is the CRB, the Commodity Research Bureau. This is the index for commodities, things, raw materials, and things that are used to make other things that ultimately we use. And this has just been going way up, but the last couple of days, we have seen a decline, but the overall uptrend is still very much intact. Here's where I want to spend some time. The CPI. The official report came out and said that we are at 7.9% inflation. Okay, that is pretty ugly in and of itself, and higher than a lot of people listening to this may have even experienced in their lifetime. Well, I grew up in the 70s where we had hyperinflation, we had stagflation, where you have really, really high inflation, but no economic growth at the same time. Is there a concern that we might be getting off in that direction now? I don't have a conclusion. I'm just asking a question that we need to be thinking about. But the reddish orangish line, this is the official number. This is what the government came out and told us. And I got this from shadowstats.com, and it's a site worth visiting and possibly even subscribing to their service. But this is the number that we were told on Thursday. Now, if we go back to how this was calculated in 1990, same government number crunching going on here, we would be up around maybe 11 to 12% inflation. Now, this isn't even the bad part. Look at this. If we go back to how things were calculated in 1980, back when Ronald Reagan was elected to be president, the red line, this is what they told us yesterday, 7.9, but we could be in this 15, 16, 17 possibly area as far as inflation if you go back to how it was calculated in 1980. And that's the freakish part. That's probably closer to what people are actually feeling when you go to fill up your car, when you go to buy food, when you do almost anything now. Are you seeing that high of inflation in your life? You probably are. And so this is more realistic to what's happening. Then I'm going to look at some of the different commodity markets just to show you, because we're seeing things that we've seen before, right before bad things started to happen. This is wheat. My gosh, wheat. Well, Ukraine is a huge producer of wheat. And so since they're having problems there, and that's an understatement, we're really seeing the price of wheat go up. Now, it fell from where it was, but still we're seeing this parabolic rise. Well, if we go back and look at other times when things have really spiked, this is in 2008. Does that ring a bell at all? And this was right about the time things were really breaking down and we had the whole financial crisis. Not really much of anything back in 2000 with the dot-com boom and bust, because wheat is a totally different than furniture.com or something. But we did see another spike back in the mid or so 90s. Well, that ended up being kind of a difficult time economically as well. So when we see these real spike ups, that just tells us, okay, we don't need to freak out necessarily, but we need to know what we're seeing and then not be surprised if that eventually bleeds over into the economy and into the stock market. And we're seeing this in a lot of different charts too. Here's another chart of wheat that I was able to find online, just to give us a little bit of perspective. Then also heating oil. Yeah, boy, we saw a real spike back in 2008. And then bad things happened after that for the stock market. We're seeing a real spike in heating oil now, with the future to be determined at this point. So we're seeing some different areas starting to give us clues, and this is part of intermarket analysis. And then nickel, which I don't have access to a chart of nickel other than going to another site and then just taking a screenshot, but it is just going parabolic as well and pretty high. When's the last time that happened? Back in 2007. I actually clicked on this to get that date. So this happened a little bit before things really got bad. And then where's another time that this happened? Back in about 2000. Right around here is when the stock market began to top out. We saw the whole dot-com boom and bust. Eventually 9/11 happened and things turned really, really bad for quite a while. Well, we're seeing a similar scenario right now. Gas. Oh yeah, have fun here. I'm going back to 2006. It's as far back as these charts will go, but just here we go. We spiked up really high in 2008 and then had the financial meltdown. Then we've had other spikes along the way, which led to some economic slowdowns, if not actual problems. Well, we're spiking up again. We went up over 3.5 or 3.6. Now realize that this is before taxes and profits, and this is the, well, it's a continuous contract, a futures contract. But if you're going, man, I'd sure like to be paying $3.13 for gas. Well, that's before all the other garbage gets added into the price that you're actually paying. So it has come off of that because we just shot straight up. But look at what has happened before. But this could even go higher. This story may not be done yet. We just want to watch these things, have them on our radar screen, and then not be surprised if we start to see things being played out in the stock market that follow what has happened before. This is the aluminum index, another one that's really been seeing a climb. It even went higher, and I did include an aluminum chart in yesterday's video, but I wanted to have a longer term look just to get some historical perspective. But we've just been skyrocketing up as far as aluminum is, even though, as far as aluminum goes, even though it's come off of the highs. As far as the Fed watch, okay, it is now almost a 96% chance that at next week's meeting, the Fed is going to raise interest rates 1/4 to 0.5%. But there's still this 4% of folks who think that there might not be any rate increase at all. And this might be where the Fed is backing themselves into a corner. We are in a high inflationary environment and also in an interest rate rising environment. Usually, we need to pump up interest rates a lot more than 1/4%. We have to go all the way up to 7, almost 8% just to equal inflation. Can you see where this might be feeding into some real economic problems in the future? I hope things turn around. I hope we can kind of get it under control and some magical things can happen, but we're seeing some opposing things all happening at the same time where none of them necessarily end with they lived happily ever after kind of a scenario. But there could be some things to come along to change all that. And then you also add to that the whole geopolitical mess that's going on. And it really makes you wonder, how are people feeling about things these days? Because a lot of that has to do with confidence. And then here's just the chart, just to show you how we're really seeing an increase in the 1/4 to half going back up. Where the 0 to 2.5 had gone off the table, it's now back on the table, and the 1/2 to 3/4 is pretty much a non-existent now. But this, we still have a few days before that meeting, and so this could change. Then another thing, even though this says March 1st, we finally got this updated. That's one of the problems, is when we get this information, is sometimes there is a delay. And this just shows the balance sheet of the Fed. That means they're buying bonds. This is quantitative easing. So we're in a rising interest rate environment, and the Fed is still buying things at the same time. They're doing quantitative easing and monetary tightening, and those two they oppose each other. Okay, so that's kind of the corner that we're being backed into right now economically. And my goodness, even back in 2008, I mean, everybody was all freaked out when we went above $1 trillion. Well, now, my goodness, 6 trillion. And this is, I point this out in a video that I did months ago on YouTube, where this is a little bit misleading. This 8M, that's millions of millions, which means trillions. So this is just going up and up and up and up and up overall. As far as this is the Fed balance sheet. These are things that they're actually buying to help stimulate the economy. And then with the tapering, that means this should be going down, but it's not. It's still going up. But yet interest rates are probably going to be raised next week at the same time, which if we're really having some problems economically, which we might be, usually that's when they lower interest rates. Well, they don't really have far to go before they're back down to zero again. Okay, as far as our technical alerts, the NASDAQ is kind of bouncing all over. 12.8, 12.9, 13,000, 13.1, 13.2. Then it went back down 13.2, 13.1, 1,300. So it was bouncing around. The Dow dropped below 33. Let's see, the Euro crossed below 110. The Euro had a good day on Wednesday, but then the dollar picked up and had a good day on Thursday, even though I don't see it showing up here. The communications, which have been getting hammered, they're starting to get extreme negative. And then gold was able to get above 2,000, at least in the futures contract. And I'll have a chart to show you there. And then here's the intraday chart where we did gap lower and we saw selling off the bat. There's a little bit of bouncing around here as the open tried to situate itself. And then we broke down through this area, which had been providing some kind of support and then potentially even resistance back here. Well, we made it all the way down to 42.10. We didn't get all the way down to S2, but then once we put that in, that was the bottom for the day, and we came back up, fell back a little bit, chopped our way back higher. We almost got back up to the daily pivot. We saw a little bit of selling and then closed not at the high, but near the high for the day. So even though we were down, this wasn't a big swing day if you measure from the high to the low. And it spent most of the day trying to repair itself. So that's a little more positive than negative. Then looking at it on a daily bar where we're still, I mean, we could still drop from here, but we're back within the lower end of this range that we've been in. And I did extend these lines over here. This is more the intermediate term support. Well, now that we've fallen through that, that may act as resistance. And then we have the longer term support, which is even below another support level of S1. This is where things could turn more negative if we start to fall down here. But we're still just bouncing around in ranges and doing a lot of treadmill action. If you look at the very bottom, you can see where volume did taper off. We are now down 11.20%, so we are in correction territory, right on the edge, but still in correction territory. Here's back way, seems like so long ago now, when we set that all-time high, and then this red line is where we closed on Thursday. Growth saw a little bit of a decline, value a little bit of an advance. Then looking at our indexes to do a ratio where we're seeing growth declining overall as we see value increasing overall. So that battle is still going on. The NASDAQ 100 underperformed the rest of the S&P on Thursday. As far as our trend, the ADX is going up. And these are pretty high readings. This is showing a pretty strong trend. And because the red line is on top, that means we are negative, even though we saw a bit of a decline in buying and selling pressure. Well, we're also seeing buying power taper off as well. The mass index, we're just kind of waiting to see because we're still waiting to, yeah, you could make a real case that we're seeing lower lows now. And we could fall off a cliff, or we're seeing on an emotional basis that sentiment is so negative that this is where a lot of bounces come from. So this mass index signal that we saw generated now is getting further in the rearview mirror and is not really becoming all that relevant. One chart that I don't have on here that I will, if it continues to improve, is that Pring bottom fisher, which is really good at picking low points in the market. That's starting to turn and could potentially be producing a signal very, very soon. Our Arun hasn't changed. It's flatlined all week. So yeah, we're seeing a decrease in selling, but we're also seeing a decrease in buying. No change in the decision point market scoreboard. As far as breadth, Because we had the down day, we saw a bit of a decline based on price and volume. And we've just been back and forth, back and forth, back and forth, especially based on price. The advanced decline ratio, it declined a little bit, but is below zero. So that is more in the negative camp. This is the one positive area that I've been trying to keep positive, but as we're seeing new highs trail off, this eventually is just going to roll over, and it might roll over pretty quick. We're also seeing it advance on our 10-day moving average as well. But right now, the trend is still suggesting that we're going higher. Accumulation distribution, we're just a little bit above the moving average, and it actually ticked up slightly on Thursday. Short term, we're just watching the 20-period moving averages in the rearview mirror. Our moving average study, 20, 50, and 200 are either kind of sideways to going down. We're well below our moving average spaghetti tree here. MACD, trying to make a little bit of an improvement, but is still negative. STO, short-term trading oscillator, negative based on price and volume. McClellan oscillator, which just went itsy bitsy positive on Wednesday. Well, now it's more itsy bitsy negative after Thursday. Stoke RSI declined just a little bit, but it was starting to head higher. Williams percent R is kind of stalled out right around the neutral area. Force index also showing a decline, but coming off of an extreme reading. Intermediate, way back in the background are the 50-period moving averages. PMO. Now, this is a little interesting. The PMO itself is negative, but it's trying to cross positive based on price and volume. We'll need to keep an eye on this. Our other PMO study, a decline in those that have rising PMOs, a decline in buy signals, and a decline in those that are above zero. BPI, bullish percent index, also showing more of a decline, and here's a longer term look. So we still have more room to fall before this gives us an extreme reading. The rainbow, yep, look at it, it's going far away. We're not even back up to the bottom part yet, and the top just continues to roll over a little bit more each day. Stochastics, still positive in the short term, intermediate term, but negative in the longer term. Summation index, a little bit flat, and again, we're seeing another potentially positive signal based on volume. See how this has been ticking up ever so slightly? Again, may provide some kind of catalyst, may suggest that there are things going on under the surface as far as volume that are not necessarily being picked up by price action, but we're seeing it in volume action. And then the only oscillator that's turned back positive is slope. And that tends to be kind of an optimistic oscillator anyway, at least it has been lately, but it's just chopping around. But all the other oscillators either are trying to improve but have not crossed positive or are still decidedly negative. Vortex, seeing a flat line based on selling, a little bit of increase here for buying, but because the red line's on top, that is negative overall. RSI declined a little bit and is below 50, so that is negative. And I took out a lot of the other rate of change charts because they're really not helping us now. But if we go back 50 periods, we are in extreme negative territory, and we actually declined a little bit on Thursday. The Sean trend meter, we're trying to come out of extreme negative territory right now. As far as our trading systems, the Elder continues to be neutral, where the stop and reverse, the SAR, that continues to be positive even with this downward action. So if you follow this, you're seeing some pretty decent drawdowns right now. Our different charts, the Heiken Ashi, it's a little more negative with the dark bar, but this is kind of got a doji look going here. KEGI, really no change since its red is overall negative. Renko continues to be negative. 3-line break also negative. Equi volume also showing more negativity, although on the 14 period ease of movement, it's still showing a bit of an advance. Point and figure, no change here. No signals have been generated. The Fibonacci, yeah, I got it right the first time. We're kind of in between the 50% retracement and the 61.8 retracement right now. Long-term charts, we are below the long-term moving average on both the arithmetic and logarithmic chart. Special K, trending lower, and just a longer-term view of this chart. This is another new one that I look at every day, but it's the first time I'm talking about it recently in the videos. This measures the 50-period moving average of the S&P 500, and then the 150 days. So this is longer term, 150-day moving average, and then the 200-day moving averages. And we are seeing that we're in extreme negative territory. We're getting extreme negative in both the 150 and 200, but we're seeing a series. We're going to have to break above this for things to turn back more positive. And we could do that, but you can see they're also tending to follow price as well. But this is just suggesting that prices and trends are going in the same direction right now. We're not seeing a positive divergence. We're seeing more of a confirmation right now. Broad market, here's the S&P. We're still at the lower end of our mess, our sideways mess. Mid caps are more in the middle, and small caps continue to pretty much go sideways. The FANG stocks were down over 2%. So they're just not getting the love they need right now. ARK, after having 2 pretty good days, well, it was down 3.5% on Thursday. Dow, also, you could say we're starting to see lower highs and lower lows. You kind of have to read a lot into that, but still, when you look at this optically, we're certainly not making higher highs in here. We're making lower highs. Small caps kind of bouncing around where they have been, although now we're slightly above the pivot. Mid caps bouncing around and below the pivot. NASDAQ, kind of not really much was decided on Thursday. Here's the NASDAQ 100. Again, it's a little bit positive that we came down to S1 and then we're able to bounce up off of that, but we need to see follow through buying for things to turn back positive. Here's the Vixen. We're kind of seeing the same thing. We saw a decline in the Vixen. This is the VIX of the NASDAQ 100, but we're also seeing a series of higher highs and higher lows, even though it did decline and we closed right near the bottom on Thursday as far as the fear gauge for the NASDAQ 100. NYSE, kind of at the lower end of the range again. The S&P 100 underperformed the rest of the S&P 500. Wilshire, also broad-based. We're getting back up into the lower end of this range. Internationally, down across the board, with China really having some trouble these days. And they don't really influence our market. They're a big player and they're starting to show a lot of volume, but they haven't become all that influential, at least yet. Our all stocks saw a little bit of a bounce on Wednesday. Well, it declined 0.79% on Thursday. Other broad markets, the dollar, which had been just going straight up, well, it saw a pullback on Wednesday and a bit of a recovery on Thursday, and it was up 0.56%. Our weekly chart is still looking pretty strong. And like I keep saying, the dollar probably will eventually fall apart, but not necessarily today. So that's why we keep an eye on this. And then oil, here we're seeing more of this is the climb back in 2008. Well, now we're seeing the real climb that we're currently going through and wondering, have we topped out or could this even go higher? Gold, also looking like a breakout, but we're still dealing with previous highs, and we're right at about the 2000 level on the futures contract. With the ETF, after having that breakout and then a real decline on Wednesday, we did see about 1/3% advance. And then here's just a longer term view, just to give you some perspective on things. Silver also looking good overall. It was up 0.88% for the ETF. And then this is just, again, another longer term view showing that we might have some overhead resistance at about 26-ish, 26 to 27 area. And then palladium also retesting that or I guess, I don't know if it's all-time high or not, but a very high and coming off of that ever so slightly. And then copper's just kind of going back into its cave that it's been in for quite a while. Bitcoin, it actually dropped below 40 on Thursday. It's trying to recapture 40 as I started to record. Futures, the S&P futures were about unchanged when I started to record. I try to look at those things right beforehand. This is one thing that could be concerning. We are seeing a drop in our yield curve here. And if this gets down to the red line, it could be signaling a recession. Looking at the interest rates, we've broken back above what had been, well, first of all, it was support, then it became resistance. Well, we've broken through resistance again, and we're back above 2% on the 10-year yield. And then across the board, bonds really declined, which means rates went up in the 30, 20, 10, 5, and even the 3-month. Internationally, the German bund continues to be positive right now as far as yield. Bonds were down 0.5% based on price and continue to be in a downtrend. Corporate bonds also seeing some weakness based on price, and we're starting to see more of an advance based on the yield. We're at 3.41, and here's a longer term view of the yield. And then junk bonds, which I started to include yesterday, we just want to keep an eye on this. When things are going a lot better and people are happier, we tend to see junk bonds going up. Well, when things look riskier and people aren't as optimistic about things, that's when we start to see junk bonds go down, and that's what we're seeing right now. Relative studies, gold against the S&P. With the decline in gold, we kind of came off a little bit of that, but it's still looking like this breakout could be valid. The energy versus the SPY is just shooting higher, which is not surprising. And then here's the growth versus bonds. So growth stocks actually saw a bit of an advance compared to bonds. Then the tech versus the SPY, it's also showing some weakness and kind of was down 1.3% when you measure these two. Here's tech versus interest rates. Tech was down, interest rates were up, and so we saw this decline continue. Then we're looking at, this is just the reverse, showing that the 10-year yield is going up as tech prices are going down. Looking at the discretionary versus staples, we're seeing a bit of a bounce here. Discretionary, even though it's in last place as far as the sector, it's trying to make some kind of a comeback right now. Whether that will continue or not, we just have to wait and see. So what are we looking for on Friday? Still, the S&P is in correction territory. We're in a short-term range, and I'm just about ready to change that to IT for intermediate term. We still have some earnings to deal with. We still have the battle between growth and value. We have consumer sentiment coming out on Friday, and then I'll have a chart after Friday's close when I do the daily video, and then I'll also talk about that in the weekly video. That's kind of a big deal right now. how people are feeling about things, but this is the preliminary report that will come out. And then, of course, we have the geopolitical events that I've mentioned numerous times already. So we are negative with the S&P, and at the bottom of that range, the short and intermediate term bias is negative, with the long-term bias turning negative with each passing day. Thank you very much. I hope you have a very pleasant Friday. I will prepare a video after Friday's session, and then over the weekend, I will do a weekly video.